Imagine for a moment, what if I tell you that by the end of this video, you'll be skilled enough, capable enough to invest in the stock market without taking anyone's help? Yes, you heard it right. And as Sir Warren Buffett frames it, the skill or the knowledge required to make money into the stock market in the long run is nearly zero. But before jumping into that, let's first try to understand what active and passive investments are and how defining your goals can help you choose the right path. Active investing is a style where a manager or a retail investor attempts to beat the benchmark performance, such as Nifty and Sensex, by actively selecting stocks that are likely to outperform and they ignore the stocks that are likely to be underperforming in the market. Passive investing, on the other hand, is either investing into an ETF or an index funds. Passive investments are funds that are intended to match and not beat the performance of an index. Let's try to understand this with the help of an example. Abhishek puts his money in a fund that tracks the Nifty 50 index. Abhishek's fund is a passively managed index fund. He pays a 0.01% management fee. Abhishek's fund is guaranteed to mimic the performance of the Nifty 50. So when Abhishek turns on the news and the anchor announces that Nifty 50 rose 4% today, he knows that his money did the same thing. Similarly, if he hears that the Nifty 50 fell 5%, he knows his money did the same. Abhishek also understands that his management fee is very small and it won't make a big dent in his returns. Rohit, on the other hand, puts his money into an actively managed mutual fund. He pays a 1% management fee. Rohit's actively managed fund buys and sells all kinds of stocks: banking stocks, real estate stocks, energy stocks, and automobile stocks. His fund manager study different industries and companies and they make buy and sell decisions based on their predictions of those companies' future performances. Rohit knows that he's paying 1% to those fund managers, which is significantly more when you compare it to what Abhishek is paying. He also understands that his fund won't track the Nifty 50. So when a news anchor announces that the Nifty 50 rose 2% today, Rohit cannot draw any conclusions from it. His fund might have fallen or maybe risen. Rohit likes this fund because he holds on to the dream of beating the index. Abhishek is stuck to the index. His fund's performance is tied to it. Rohit, however, has a chance of outperforming and doing better than the index. So after reviewing these examples, you can see the reality of how the two different kinds of investments operate, and now you can have a better idea of which might work for you. But this is not all. There is a little twist to it. The definition of passive investments have been modified with time and it is not just limited to the index funds anymore. So as per the modern definition, the philosophy of maximizing the returns by minimizing your cost of buying and selling by not actively participating into the market is called as passive investing. So you see a person who buys and holds a particular stock for a very long time. They can be called as a passive investor. Passive investor believes in value investments and he invests his money into one asset class for a very long time, or say until the time he sees the fundamentals of the product going wrong. So there are so many products. Like you can think of a person who wants to buy a land. He plans to keep it for another 10 to 15 years and enjoy it after his retirement. So he's a passive investor who knows the land prices in this country will keep increasing and he has seen it in the past as well. He does not actively check if the price of the land is increasing and he sells it as per his requirements. So a passive investor is a person who either buys and holds stocks or invests into an index fund. A passive investor who holds stocks also attempts to beat the index fund. Index funds have given 12 to 13% returns historically and they're considered as the safest option in the stock market as they are a bet on the economy of a country. One is putting their money on the best companies of India. The RBI and the government back these companies due to multiple reasons, and in case a company performs badly, then it is thrown out of the Nifty 50 and a new company comes at their place. So it always remains a win-win situation for an investor. And since the risk is low, so the return is also low as compared to the actively managed funds. Remember, passive investments are always done with a time horizon of more than 15 years. Now coming back to active investing, if one looks at long-term record of managers, there are a very few active managers who have been able to outperform the benchmark returns. Even after a lot of research, higher cost, and relative difficulties of fund selection, active managers are unable to outperform the benchmarks. In such a scenario, it is obvious that most global investors nowadays prefer to have higher allocation to passive funds rather than the funds which are active in nature. And it is a fact that over 15 years, only 22% mutual funds are able to beat the index, and over a period of 30 years, less than 1% actively managed fund has beaten the index. So, our best bet is to avoid debt, ignore the brokers and other experts out there, just do some savings and buy the Nifty index. That's it. That's what works. But most people, they refuse to do it. They get impatient and damage their investments by thinking that they have to dance in and out, trying to time the market, outsmarting others, etc. etc. They feel the need to do something instead of doing nothing. Recently, one of the biggest US financial consultancy firm known as Fidelity found something funny. Their best account holders are dead. Yeah, that's right. People that died and couldn't meddle, couldn't interfere with their accounts got the best returns. The sitting, not the thinking. That's where the big gains are made. Let's understand this with the help of an example. Suppose you decide to invest rupees 1500 per month into an index. You have to increase the amount by 10% every year. Now if your investment grow at 11%, then you'll get a sum of rupees 1 crore at the end of 30 years. See, historically Sensex has grown at an average CAGR of 16% over the last 41 years. So I assume 11% is a safe number. So now you know that you can invest in the performance of the Nifty and earn compounded returns. When the Nifty goes up, you'll make money. And if Nifty comes down, you will lose money in the same proportion. So how to directly go and invest into Nifty? For that, you need to go and find out the weightage of each stock in Nifty and buy only that much value of stocks into your portfolio. But doing it in this fashion is very complicated and you won't be able to achieve it as a retail investor. Your minimum investment size may go up to 10 to 15 lakh to achieve it. So in order to simplify it, some companies came forward and said that give us the money. We will allocate this money in such a way that it will track the performance of the Nifty itself. To track the index, instruments such as ETF and index funds were made. You can buy ETF on the stock exchanges just like the stocks, and you can buy an index fund just like a mutual fund. You can open an account with discounted brokers like Zerodha and Upstocks, which are the biggest brokers of our ecosystem, and start with your passive investments. Moreover, our team has recently partnered with Upstocks, which is also an official partner of IPL, and there is a limited period offer where you can open an account for free. Yes, and that is not all. Open an account with the link in the description and send us a screenshot. You'll get a free ETF worth rupees 150 from our team to start with your investment. You can find our WhatsApp number in the description. See, there will always be active managers who will outperform and beat the market, but the challenge is how to find them. Now, by any means, I'm not demoting you to trade into stocks. I love stocks and I love investing in them. It's just that you have to identify what is best for you after taking your financial goals into consideration. Investing in stocks requires more knowledge, patience, and understanding of finance, which you cannot develop in a single day. Stocks can outperform the index, and there is no right and wrong between choosing a stock or an index fund. Investment is all about diversification, and actually, it should be a blend of both passive and active. See, if your top priority as an investor is to reduce your fees and invest less time in the market, then an all passive portfolio might make more sense for you. But investors tend to care more about factors like risk, return, liquidity, and that is why I believe that a mixed approach may be beneficial for all kinds of investors. So, summarizing what we have learned today, active investment is all about trying to beat the market benchmarks such as Sensex and Nifty. Number 2, passive investment is a safe option compared to other stock market instruments where investors buy and hold stocks or an index fund. Number 3, a majority of active fund managers have not been able to beat the market returns. Number 4, ETFs and mutual funds can be used to invest in an index fund. Number 5, a balanced portfolio should be a mix of both active and passive investment. As always, I'd like to end the video by giving you a call to action. In the description, you'll find a link to the compound interest calculator. Click on the link and change the return rate to 16% for the same time frame as I told you in the above example and see the difference. So that's it guys. Hit the like button if you liked the video and share it with your friends as well. So basically this video was a part of the basic stock market course that we have created. So you can click on the I button and watch the rest of the videos as well. So thank you for watching the video. This is Srijan Barnwal signing off until we meet again.